The Financial Huddle does not provide tax, legal, financial, or other professional advice. Listeners are encouraged to consult with their own advisors in these areas.
All right, everybody, huddle up. Play calls in. This is the Financial Huddle. Ready? Break.
Well, hello, huddlers. Welcome back to the Huddle Nation. And let me just start off by saying it is with great sadness that I am going to announce that this is going to be our last huddle session ever. It was a good burst of energy while it lasted.
Hit you right here, man.
Yep.
Yeah.
I mean, we gave it a try.
Huddlers, we love you.
Give it the college try.
We love you, huddlers, for tuning in. And so that's why we just got to let you know. Psych.
Psych.
April Fools. Gotcha.
You can't get rid of us that quick.
Gosh,
We're never leaving.
we're
leaving.
We're so immature. But in all seriousness, welcome back, huddlers. Happy April Fools. Wherever you are, wherever you may be listening or following us, thank you for coming back in. Brian Manier here to my right.
Hello.
Ed B. Miller to my left.
Hello, hello.
Let's get it done, fellas.
Let's go.
Do it.
So, the title of this episode, as you guys saw, was "What is your largest expense in retirement?" So, Ed, I'll ask you first. What's going to be your largest expense in retirement? What do you think?
I'm going to get one of them, Lamborghinis where the doors open up, sideways or up or whatever, and then
Mr. Beast, you're going to get one from Mr.
yeah,
Beast.
yeah, and then just cruise the strip.
The
You look-
Lambo.
I'm not
good,
sure
Matt.
what strip, but I'm
look good,
cruising
Matt.
some strip.
That's
Business
a quarter,
must be good.
Yeah.
$250,000.
Well, by then we're selling for millions.
Oh,
so,
yeah, okay.
I'm retiring on.
Brian, what about you?
Listen, I'm retiring. You guys remember, you are my.
We're the backup, right?
You're buying me
he's
out.
a clown.
I'm the old
Yeah.
man. I'm the
What
old
about
man of the
you,
group.
man?
Well, I'll tell you what it feels like.
What?
And you're feeling this. 2 kids in college.
In retirement, you're going to be paying back the loans?
Probably.
It's not going to allow him to retire.
Definitely.
So he's confusing retirement. I'm like, I'm never going to retire.
I don't know. My daughter's talking about going to grad school.
Oh,
It just
yeah.
never ends.
You blew all your money.
Yeah, right.
All right. Well, I hate to bust your bubble, but that's not going to be your most expensive part, and that's not going to be your most expensive thing. And huddlers out there, you may be thinking, like a lot of people, the most expensive part of retirement is going to be healthcare. Okay.
Yep.
You get that
So
a
a
lot.
lot of people say that when I
Get
ask
that
that
a lot.
question.
Get that a lot, but the answer is it's taxes, and it's not even close. So, a lot of you may remember when we first started, or some of you that know me in particular, a lot of my background prior to the financial services arena was baseball. I got to live my dream, and I got a chance to play professional baseball. This time of year is super nostalgic to me. Sometimes it's emotional. Sometimes it's just, like I said, super nostalgic. But the MLB season kicked off a few days ago. We're off and running. The boys of summer are running around. I miss the smell of the grass. I miss putting on the uni. I miss
I'm about to smell that leather mitt.
I
that.
like
Oh,
the leather
yeah.
mitt.
Oh, yeah.
I like that smell.
And, like hitting some doubles in the gap every once in a while. But I loved everything about the game of baseball. So it got me thinking relative to this idea of taxes and how expensive the things are. A lot of people know Juan Soto. And if you don't know Juan Soto, he's one of the best players in the world.
Yep.
Young phenom, hopped around to a few different teams. But a couple stats here I wanted to make sure you guys were aware of. In 2025, good old Juan Soto signed a 15-year contract. Now, if you don't know this, when you sign a contract in the MLB, it's guaranteed. So if you snap your leg the next day, like your contract, you're going to get paid. Okay, but Juan Soto signed a 15-year contract worth $765 million.
Millions of dollars.
Think about that.
That's
okay?
a lot of money.
Including
Obscene.
a $75 million signing bonus with no deferred money. A lot of these guys like Shohei Ohtani, and they sign these like multiple $1-million contracts, but they defer a lot of them. He did not. He had no deferred money. But let's put this into context. So on average, he's going to make $46 to $47 million annually. And when it's all said and done, he's going to be expected to pay about $364 million to almost $390 million in taxes over the term of this contract. Okay, just let that breeze across your brain.
Give that figure one more time.
Yeah, so over the course of his contract, a 15-year contract, he's going to be estimated to pay $364 million to almost $390 million in taxes over the 15 years, which represents 47, just under 50% of his contract being paid out in
Taxes.
I mean, that makes me want to vomit.
That's a lot.
Okay.
Well,
And-
I don't feel really bad for Juan because,
He'll still be okay.
even paying that amount, half of, what did you say, 765 million was
Yes.
the contract?
He'll be okay.
I think he could live on it.
He'll be all right.
His kids will be okay.
He can get by.
Well,
He
a
can
lot
get
of
by.
people probably out there that are listening kind of feel like they're paying half of their money in taxes
Yep.
and things like this. And this isn't so. And this isn't even counting the maybe 4 or 5% he pays Scott Boris's agent, right? So my point about this is, huddlers, is that this $765 million that he signed for, it's not all his. It's not all his money. And millions of people and the people that are listening and watching us here today, it's going to be really hard for our clients to plan for retirement when they don't really know how much of their own money is actually theirs versus the partner they have in this called Uncle Sam.
Yep.
So, for example, a lot of people on this podcast here that are listening might have eventually one day may have $500,000 to $1 million or more in a traditional tax-deferred 401k, but that's not all their money. And they're going to have a partner the rest of their life unless they do something about it and get off the tracks now or later. And if taxes are going to go up in the future, every year that goes by, the government gets to vote on how much more of your profits and how much more of your account or your money they get a chance to keep. So, we want to make sure we understand that because we're all going to be tied to this monster our entire life.
It's a topic you cannot ignore.
Yeah. What do you say? You
If
pay
you're-
taxes and
Right.
die.
And die.
Death and taxes.
So I thought maybe what we could do is bring this home a little bit and talk about, well, if I'm going to be tied to this tax monster my whole life, what's the status of the union here as far as taxes and the environment? How much am I going to pay?
What time is it?
It is.
It is
Stat time.
That time. We need a button. We need a little bell or something. So as you talk about taxes, and we don't have a crystal ball, we don't know exactly where taxes are going to go. However, most people, when you ask the question, where are taxes going to go? Most people, you say, are they going to go down? Probably not. They're going to go up. So here's some stats. Here's some information that we would say is evidence that taxes probably do have to increase in the future.
All right.
Let's talk number one about Medicare. The Medicare Hospital Insurance Trust Fund is projected to be unable to pay full scheduled benefits by 2033.
Ooh.
That's not too far in the future.
Yeah, that's negative.
And so if that runs out, it could cover only about 89% of scheduled Part A benefits. That we're just talking about schedule Part A benefits for Medicare. So that's Medicare, which millions and millions of people rely on that for their health care.
Once you hit 65,
That's right.
Game on.
Game on. Okay. Let's talk about Social Security. If you've looked at your statements, you know there's some language in that statement that talks about the shortfall. So the Social Security Old Age and Survivors Trust Fund, the OASI, which is basically the bank account for Social Security, is projected to be exhausted, surprise, surprise, around the same time, 2033.
Okay.
Which benefits would be cut to roughly 77 to 80% of the scheduled benefits or benefits needed for people that have filed.
And we've
for
said this in
those.
the past, others. That doesn't mean Social Security is going away. Your benefit might get reduced a little bit based on that math.
Yeah, because FICA taxes are still going to be taken out of if you go to your pay stub and you look at it, FICA taxes are still going to be taken out for income. But what is being used to pay the difference of their shortfall now is that fund, and that fund will be
going to be exhausted.
Okay, let's talk a little bit about the U.S. national debt. As of 2025, the gross national debt has surpassed 38. Let me see that pinky, Ed. But this time,
time's
trillion.
trillion. We skipped billion.
You almost said B. You almost said
We
B
skipped
for
billion, right?
Bajillions.
Right to trillion.
$38 trillion. When we say that, like, we really have we can't fathom how much that
we just
is.
blank out.
It's monopoly money, right? I mean, it's like
it
38 trillion. What?
Here's a good stat real quick. Huddlers, anything with the word trillion in it is followed by, do you know how many zeros?
A lot.
12. 12 zeros after a trillion. Okay, there we go.
Yeah. Now, I know, Ryan, you follow Lawrence, and you can help me with this.
Lawrence Kotlikoff.
Yes, he is a very well-known economist.
Yeah, Boston University.
Boston University, and he actually talks about the scheduled unfunded obligations could estimate around $200 trillion.
Yeah, and Hullers, what Lawrence Kotlikoff's talking about is this: when you add up everything that's unfunded with like Social Security, Medicare, Medicaid, the interest on the national debt, he's actually trying to calculate the true national debt that we have, the true hole that we're in, not just the 38.
Yeah, not just what we owe now, but what we're going to owe because of all these unfunded
interest carry.
obligations.
Have rates been going up?
All
Yeah, they have.
stuff.
Yeah.
It's called fiscal gap accounting.
Yep.
Right.
The last thing that I want to talk about that people don't think about when it pertains to taxes and the increase in taxes is what's called the Great Wealth Transfer. You guys ever hear about this?
Oh, yeah.
The Great Wealth Transfer. And what this is referring to is all those retirement accounts that people are not going to spend down before they pass. And what are they more than likely going to do with those? Pass those on to
Legacy
their kid.
planning.
Legacy planning.
Right.
Wikipedia estimates there's going to be $84 trillion by 2045. Now think about that. We've been doing this a long time. Most of those are in the form of what kind of assets?
Stocks.
But
funds.
from a
Most
tax
are
perspective,
they're pre-tax.
they're pre-tax.
Pre-tax.
Yeah.
So we've talked about this in the past. When you inherit an IRA or a 401k, what do you have to do with those? Spend them down in 10 years.
Unless you're the direct spouse.
That's right.
Of the
But
deceased.
for most, if it's a child and you pass that down to your adult child, that adult child at that point in their career is probably in the very sweet spot of their earnings.
Yeah.
Which means what? They have to spend it down in 10 years. Ultimately, they have to pay the taxes, which more than likely is going to put them in the next highest tax bracket.
Yeah, and that's if taxes remain the exact same that they are today. And Huddlers, you may remember we talked about this gentleman named David Walker, who was the former U.S. Comptroller General of the U.S., who basically was the CPA for America. He knows all the math that we're talking about. He knows kind of the math about what Lawrence Kotlikoff's talking about. And the point I'm going to get across to everybody that's listening is that the fact that we are in this situation and the fact that the evidence is really pointing to potentially much higher taxes, or what David Walker says, maybe doubling of taxes in the future, just kind of brings to light more about why we wanted to talk about this. So therefore, if taxes truly are the biggest expense in our lifetime, when do we want to get off the railroad tracks, basically? When do we want to get off that business partnership with the IRS and pay the taxes now versus later? It's important to think through.
Yeah, and that's where, we as financial professionals, when we're sitting down with our clients, if you know that this potential significant increase is coming and that it could once again be your largest expense in retirement in your lifetime, do you think you should talk about it?
I think it should be at the forefront of all conversations.
Yes, all conversations. And there are things that you can do to help mediate that concern.
Mm-hmm.
Maybe not 100% eliminate, and that's probably what we wouldn't say to do, but there's definitely things, to mitigate that future
in light of this fact
loss.
We have to bring in a lot more revenue as a country.
Let's also be clear. Even if things don't change, taxes are still going to be your number one expense, even as it is right now.
Yeah. Exactly.
And there's still things that you could even do now as current situation stands. But in evidence of everything we talked about, it's probably going to get even worse.
Yeah, it becomes more pertinent.
We need to organize our affairs a certain way.
So when we look at assets, and Ryan, you've said this before, if we look at different buckets
that's right,
assets can be in, there's 3 different buckets, right?
That's right.
You basically have
taxable,
tax deferred,
yep,
and tax free.
That's right.
Okay.
Right. Out of all the things that all the millions of different strategies we can put our money in,
right,
it really just boils down to our money can sit in one of those 3 buckets or all 3.
Right. And those are how those accounts are viewed in terms of the IRS, our partner that we did not elect, right? So we are, all 3 of us are business partners, right?
That's right.
We elected to join together and to do what we're doing.
Yes, we did.
You do not have.
Do you have any regrets?
But we had choices, right? We had choice.
That's right.
He knew what he was getting into.
Yeah. What you don't have a choice with is your partnership with the IRS and the federal government.
No, you do not.
So if you could take advantage of more favorable terms potentially, and that's where we're not saying stick everything into one bucket. But what we are saying is that, planning for that and looking what your needs are, looking and having that discussion of, well, how much should be in the tax-free bucket? How much should potentially be in the pre-tax and then taxable? And it's going to be different for each individual.
Yep.
But once again, it's something, to use a double negative, it's something you cannot not address, right? I mean, it has to be part of every financial conversation.
A double negative from an English major?
Well, that's why I had to preface it. Not to use a
He
double
covered his-
negative,
he covered
which
his
I
butt.
then did.
It's like when someone says, I'm just saying.
I'm just saying.
To be honest with you,
Yeah,
well, okay,
right.
well, are you lying to me
Right,
normally?
right.
What's going on here? And once again, the amount of earnings or income that we have that is taxable versus tax-free has ripple effects, right? And especially once we get into retirement, and we'll talk a little bit in the next episode of what are the impacts on your Social Security. I'm not talking the impacts of how much you get, gross. I'm talking about how much you get net. A lot of people are like, oh, I don't pay tax on Social Security. Well, yeah.
Yeah.
Most people do.
I thought that was tax-free.
Yeah, tax-free. Well, that's what Trump said, right?
We've talked about it in
we
previous
talked about that in a
episodes.
previous episode, and how much you show in taxable income is then going to basically tell you what percentage you're paying in taxes at a very high level. We'll get more into that.
That's right.
And then also at the end of the day, we've all heard, the saying that you can't take it with you, right? And that describes legacy.
Yep.
So in a perfect world, if legacy was part of what you wanted to accomplish for your children, grandchildren, your church, a nonprofit that you really want to support, if you can pass on those assets as much tax advantage as possible, i.e. tax-free, versus putting additional tax burden on, isn't that something you'd like to know about?
Some people would want to, some people don't, but
and
some
even
people
you
will.
said, depending on how you want to pass those on, is going to be different on how you take those distributions.
Correct.
So if you give it to a nonprofit or your church, you don't necessarily need to do the tax planning to move things tax-free, because you can give those assets that are pre-tax to the nonprofit.
And if you did, even if somebody didn't really care or want to have a legacy to the next generation, again, you would rather divorce yourself from that partnership as fast as possible if taxes are going to be higher in the future, right? So you can spend more of your money now, right? So,
but without planning for it and having your will be known, right? As far as what are your wants, what do you want to happen? You have to take in consideration the topic of taxes.
Yeah, and that's really, we'll put the bow tie on it. I mean, at the end of the day, we wanted to do this episode to make sure you guys, the huddlers, know that the number one expense by far is taxes in retirement. It's not medical, and it's not really anything else.
It's not your mortgage.
It's not.
Yep.
And so therefore, then we must be cognizant of this. We must talk about it. It's not just about rate of return. And so next episode, tune back in, huddlers, because what we're going to do, we're going to go a little bit deeper, and we're going to talk about, I would argue, probably the most popular wealth savings engine in the world for people's retirement, that started to originate towards the late 70s to 1980, called the 401k. There are so many trillions of dollars sitting in tax-deferred vehicles called 401ks, and we're going to kind of stress test which is better. Is it the pre-tax 401k, or is it the after-tax version of the 401k? So this kind of falls in line with some of the things we're talking about. But huddlers, as always, we hope you got some good education today. We hope you are more aware of this tax burden that is going to be riding with you your entire life. Tune back in, like, follow, share, subscribe, whether you're driving in the car listening or just watching us on YouTube. We're thankful so much. And if you want to talk a little bit more about this specific situation that you're in with your taxable buckets that Ed talked about, just give us a call. We'd love to kind of help you out there. All right?
Sounds great.
All right, guys. We'll see you next time.
Yep. Until
All right,
next time.
Take care, huddlers.
Everybody.